Welcome to another sunny day on Wall Street. Welcome to the world of personal finance. I'm Mitch Goldberg, your host. You're watching my live stream, Be the Boss of Your Money, because I really want you to be the boss of your money, not your money to become the boss of you. You know, that's very easy to happen if you're not careful. So let's be careful and watch this show and talk about personal finance. Today, talking about protecting your stock market investments, potentially because of a dip in the most speculative, frothy parts of the stock market. Is it a good thing? Is it a bad thing? This requires further examination. So you're watching Be the Boss of Your Money, my live stream. We're going to roll the introduction and get into this. If you have any questions, comments, hit me up in the comments with questions. That's the deal. If you have words of wisdom, words of encouragement, those are always appreciated as well. So let's roll the intro. Your questions, please. I love hearing from you, whether if you're watching in the live stream or replay. Here we go. Hey there, it's Mitch Goldberg. If you're just joining us now, you are watching my live stream, Be the Boss of Your Money. It's all about personal finance, making you better with your dough, okay? So we've got a couple things to talk about. Yes, I love to do the market update because I had a lot of perspective, like what all the things mean. What does the small cap stocks going up mean? What does large cap stocks going down mean? Let's take a look at the different sectors. I add perspective so that you know what you're doing as an investor. Not to say that you didn't know what you were doing, but to say you know more of what you're doing. I'd like to welcome a few new guests to the show. Behind me and to the left of me, this is my left over here, we've got the three little bears. Aren't they so cute? They're grizzlies, okay? They're grizzly bears, plushies. And behind me, we've got the three little bulls. What better motif for a financial advisor doing a live stream than to have bulls and bears in the background? I actually have them for some sound absorption because the acoustics with the hardwood countertops are not very good, but it's tough to really throw in acoustic treatments and all that in the background. I just don't like the way it looks, but I like these guys. So they help absorb some of the sound. So we've got the bulls and bears working for us. Welcome to them. We're going to talk about meme stocks, and our meme stocks about to flush the market down the toilet. So these are some of the things that we need to examine. I see a few of you out there. We've already got somebody out there in the comments. It is, Jonathan Bednar, the second CFP, three little bears. That's awesome. Thank you very much, buddy. These bears, it's not too hot, it's not too cold, it's just right. It's Goldilocks. What up, Peter? How are you? Peter, one of these days, I'm going to have to take a picture of you so you could add the picture to your Facebook profile. Okay, that'll be fun. I'll do it for you. Okay, so we've got a couple of things to go over. So I'm going to do the quick share screen with you, the old share screen, and then I'm going to pop myself up into the corner. So let's go to screen 4. Put myself in the corner there, and I know you could barely see this on your smartphone. So let me make this a little bigger. Okay, let's start with the heavyweights, the big cap stocks. Apple, new all-time record today, just about $150. $2.5 trillion market cap. Today, JP Morgan named it as one of their focus stocks, implying a 20% potential gain in the price of Apple over the next year. 20% on a $2.5 trillion company. I mean, that's another $500 billion of market cap. So they believe the stock could go to a $3 trillion market cap. How big is too big? Is there like some kind of natural limit on how big a company could get? I mean, it's just massive. And I could understand if you think it's a little frightening to do that, to get into valuation so big. Amazon up a little bit, not far from its high. Facebook up a little, down a little bit, no sweat. Alphabet, which is Google, okay, up a little. Microsoft, Nvidia off a little bit. Overall, a little bit more up than down on the FANG stocks, which is what helped lift the S&P 500 slightly today into positive territory, just because of the gravitational pull of these mega cap stocks. By the way, we got producer price index today, way higher than expected, confirms what we saw with the consumer price index yesterday, but nothing seems to be moving on it. And we're going to take a look why. So Dow barely up 44 points. We're gearing up for 35,000. Just so you know, and just stick with me. This is going to be, I'm going to start to, pick up the pace a little bit. Okay. But I actually got a call from a journalist at NBC this morning, and to talk about the $35,000 level and what does it mean, and does it draw in more investors? And also she asked me about what do I think about investors doing well right out of the gate, novice investors on Robinhood, Webull and other apps. And I said to her, I think the worst thing for a novice investor is to do very well right out of the gate. I'm not saying I want people to lose money in the beginning, but the worst thing is when investors get this false, fake validation that they're actually good at this game. And that's a big thing. So that was my overall takeaway. And we spoke last night via email about Jerome Powell, and would it be possible for Biden to appoint a new Fed chairman who's even more, I guess the word is more progressive than Fed Chair Powell. Fed Chair Powell has taken the Federal Reserve in a different direction, where it's not just about employment and inflation, maximizing employment while minimizing inflation. He's going for more of an equitable distribution in terms of jobs and jobs opportunity. I'm not knocking it, but that does have a tendency, as you can see now, to let inflation start running away. Now, he does see inflation as mainly temporary. What economists are coming down to on this, and then I'm going to get to the next subject, is that it's not so much the inflation of products like lumber. I'll show you a quick chart on lumber that you should see this. This is lumber year to date. Lumber is actually down on the year. Look at this whole triangle up here. That whole triangle was just cut off. So and a lot of products are going down in price. But one thing that is sticky is wages, unless you have like a really nasty recession and you see wages come down. Okay, so NASDAQ was off a tad bit. S&P was barely up. Gold up a little. Actually, it's a pretty good day for gold, at 1%. Energy off about 2.3 after having a good day yesterday. But this is the beef. This is everything right here. The beef. The 10-year Treasury yield is back down to a little under 1.35%. That if you are somebody who's worried about inflation, this is contradicting you. So do you believe in the real world, or do you believe in the financial world? Who do you believe when you gauge price pressures? The financial world is telling you have nothing to worry about as far as inflation goes. And inflation has been rising long enough to give the bond market enough time to adjust to higher inflation. But still, there's no belief that inflation is going to stick around. So if you take a look at a few other things, the VIX was down a little bit, 16, still a little under 20. So I'm not too worried about that. In other words, if you want to see a real spike in volatility, maybe you don't want to, maybe you do. If you see a spike in volatility, it's going to be when the VIX breaks above 20. And that's when we start talking about, is this just a 5% correction? Do we go into a 10% correction? Money coming out of the market? Because right now there's a lot of rotation. There's a lot of winning sectors, losing sectors. The reflation trade stocks are up, then they're down. Then the work from home, stay at home, secular growth technology stocks are leading the way. Then they're down, then they're back up. So money's moving around, but it's not actually leaving the market. If you're just investing in an index, like if you're investing in the S&P 500, things are very calm to you right now. Now, the S&P 500, just have to say, it's an index. You can't invest directly into an index, but you could invest in a security that tracks or mimics an index. And it's, by investing in ETFs, exchange-traded funds, and mutual funds, it's a good way to get broad diversification. Diversification is a strategy that we use that helps minimize risk, but it does not necessarily protect your portfolio from going down in a generally down market. I've got to get these disclaimers in. I'm getting pretty good though at saying these. I've got to say, I'm like right on it. Oh, Asher. Okay, Asher. I have to get ready for this. Okay, Asher. This is for you. I spoke with Asher. Asher's watching, gave me a heart for the show. Asher and I are fast friends. We know each other from social media, and I was at a great event last night. It was my first, big networking event at night in a year and a half, and it was awesome. Right back at you, Asher. So first of all, during the pandemic, Asher put his time to good use and earned a master's. Congratulations. That is incredible. He also owns and operates a business, commercial lending business. So it's very impressive, very smart guy. We're talking about the market and stocks, and we enjoy that. Anyway, we met on social media. We finally met for the first time in person yesterday. And, we're like, it's really cool when that happens, you could just leverage meeting so many people on social media, but then when you take it to real life, it's just it blows my mind. I really enjoyed it. Anyway, so Asher gave me the example of the unicorn. This is the unicorn market. Things are great. Things are going up. The money has been easy, which we talked about last night. Seems like it's been easy up until very recently. And he says, we're in the unicorn, but it's the part of the unicorn. As Asher says, we are right now we're at the butthole of the unicorn, and we are the shit about to drop out behind the unicorn. That's more or less what the analogy is, right? And okay, so that was a little crude, but Asher, I promised you, if you watch the live stream, I'm using your analogy, and I did it. Okay, promise made, promise kept. I feel so good about it, though. That's cool, man. I told you, this is a cool. So look, this isn't TV and it's not cable TV. It's live streaming. So I'm not really sure what all the rules are. Okay, so it gives me some smileys. Yeah, laughing out loud, and said perfectly. Okay, thank you. I'm glad. I'm representing. Okay, and Peter is out there. Peter says I'm not pretty looking. Oh, come on. We talked about him putting a profile picture up. I'll send you a picture of me and you could, use that if you want. All right. It's the least I could do for a good friend. Okay. So thank you very much, Asher. So anyway, we're talking about the yield on the 10-year treasury is a little bit under 1.5%. So we are getting such mixed signals, and this rally truly is the rally that everybody loves to hate. You like my setup over here? I'll pop myself up in the corner so you can see. So this is my setup, by the way, and this is my sound pad. It's my iPad. I could use it as a sound pad. So, if I want to say, like, give the unicorn example, and then I could go. All right. So when I want to get into is what the heck is wrong with the market, and why do people love to hate this rally? Because we're right off all-time highs and all the major averages. So if you think about it, does anybody have anything to complain about? But a lot of people's portfolios are doing a lot worse. So your boring, average, ordinary index investor is actually doing fine. But there's something beneath the surface that is really starting to swirl around and create an undertow. Look, I'm from Long Island, so we're very, we're beach people. So we know what undertow is. And that's when you can't tell by looking, but when you swim out in the waves, sometimes there's an undertow, like almost like a whirlpool that sucks you under the water. And the idea is you're supposed to swim sideways along the shore to break out of the undertow. Don't try to fight it by swimming back to shore. You'll get too tired and you won't be able to fight it. Okay. So, man, I am digressing. My ADD is kicking in so freaking bad right now. It's crazy. What? Oh yeah. So the meme stocks. So here's what's going on. When markets rally, you have so much liquidity in this market from stimulus, from from zero interest rates, from the Fed with its quantitative easing, buying $120 billion of bonds every month, from all the fiscal stimulus thrown at the economy. There's so much money going around that it finds its way into stocks. And then it finds its way into more aggressive stocks. And then it finds its way into meme stocks and crypto. And that's where we start to get in trouble in a way. It's good that everything participates because it shows that there's a lot of energy behind a rally. But then when a lot of stocks start to pull back, and first there was crypto that tanked shortly after Elon Musk touted Dogecoin, which again, I am so against him doing that. My friend Filippo, by the way, newsflash, my friend Filippo Impinato is going to be my guest next Wednesday. We're going to talk all about crypto. Of all my friends in my little world, he is the most knowledgeable and most enthusiastic about crypto of anyone I know. And yeah, he's a good friend too. So it's going to be a lot of fun. So like Dogecoin, most of the Dogecoin, something like 80% of Dogecoin is held in only I don't know. Do you see the screen skipping like that? It's driving me nuts. I see it on my end. Only like 5 wallets hold almost all of the Dogecoin, like 80% of it. And Dogecoin, it's not that hard to mine like Bitcoin. You don't need that much technology and sophistication. So if it costs you a couple of pennies to mine Dogecoin and you could sell it now in the market for 20 cents, you're just going to keep selling as much as possible. And there's no limit to how much Dogecoin could be created and put into the open market. So that's why I don't really, I think the Dogecoin, the fact that you can have an unlimited amount of it is totally counter to the idea of going into something like a Bitcoin, which has a finite amount. You can't make an unlimited amount, kind of like the US dollar, where we're just printing virtually unlimited amounts of dollars, the Federal Reserve. Okay, so having said that, so that's the way it works. Then the speculative aggressive stuff goes up last, but that stuff also goes down first. And from what I see, money is coming out of the speculative, super speculative, aggressive type of investments like meme stocks. So I'll just show you some meme stocks. I have my list of meme stocks. By the way, my list of meme stocks is called, it's actually called meme stocks. Okay, so AMC. Okay, if you look at AMC over here, you see this line over here where I'm moving my cursor from 72 and $1.91. That's its 52-week range. It's now below the midpoint of its range. I mean, it's still up a lot this year, don't get me wrong. But considering people were to the moon at 50, at 60 on AMC, and now it's 33, down 15% today. That's a hell of a hit. All right. GameStop was 483. Now it's 167. Bed Bath and Beyond was in the 50s. Now it's about half. So these stocks are either all cut in half or more than cut in half. Clover down to 8 from 28. I mean, that was 28 like a couple of weeks ago, wasn't it? Wendy's is from 29 to 22. So that's down below the midpoint. So these stocks have gotten absolutely crushed. And then you take a look at we'll look at the big one, Bitcoin. Let's take a look at a chart, okay? This is a year-to-date chart. Look at this. It was all the way up here, and now it's all the way down here. My issue is that Elon Musk said we bought $1.5 billion of Bitcoin on our balance sheet so we could accept Bitcoin for cars. Then he said, forget Bitcoin because it causes too much pollution to mine for it, because you need a massive amount of electricity to mine Bitcoin. It's extraordinarily difficult and sophisticated operation to mine Bitcoin. Then he touted Dogecoin, and then that tanked after. So anyway, the point is the speculative stuff comes down first, and then it spreads to other more aggressive investments like small caps. So now the small caps are struggling, and now bank stocks have been struggling as of late. That's not a good sign for investors. That, I'm not saying like bank stocks had a couple of bad days and they're already back to recovering. Like the sector just keeps getting pounded and pounded and pounded. So my concern is that the really aggressive, hyper aggressive, crazy speculative stuff, when that stuff starts to go down, it's a sign that money is leaving that space and investors are going into the mega cap tech stocks. And they're going into the mega cap tech stocks as more or less as a flight to safety. Now, typically you think of the flight to safety would be into short-term treasury securities or gold. But the perception is that Amazon, Facebook, Alphabet, Microsoft, that these are the safety trades. Okay. Let me get out of that screen. So money is going into what's perceived as the safety trades, these super large mega cap tech stocks like Microsoft, Apple, Microsoft, Apple, I say them every day, Facebook, Amazon. Okay. So, and by that happening, it's pushing these stocks, which are hitting record highs. They're going up and they're pulling the S&P 500 with them. They're pulling the S&P 500 up with them. So the performance of the S&P 500 index is masking deterioration beneath it, because there are so many stocks that are below their 50-day moving average in the S&P 500 while the market appears to be going higher. This is a similar situation to January, February, and March of the year 2000, when a lot of stocks were going down, but you didn't know it because the top 10 stocks, companies like Dell Computer and Lucent and Cisco, kept going up because people were going into those stocks with a feeling of safety. You could also throw in America Online, AOL. All right. So I think that a signal to watch out for is that the deterioration in the more speculative, aggressive part of the stock market, when that's coming down, it's not a good thing because the rally is losing energy and investors are more or less camping out in the mega cap tech stocks until money stops moving from the speculative sectors into those. And then where do you go from there? So that's what we have to watch out for. And if you have a time horizon that is not as long as it used to be, it really behooves you to make sure you are investing accordingly, because your time horizon is how you start setting your risk tolerance. I want to thank you very much for watching. I'll be back tomorrow, and I want to wish all of you a very, very good night. I'll see you soon.